Greetings from all of 5-Star Metals. My name is Ty Chapman, the president of 5-Star. I decided to do something a little differently today and record this video in beautiful Galveston, Texas, where the weather is perfect. And behind me, you can actually see the offshore platforms that are getting serviced and repaired. Today, we're going to talk about earnings. One of my favorite times of the year is earnings season because we get to hear what some of the CEOs of the world's biggest oilfield services companies have to say about the state of the market. And remember, I've talked about this before in some of the articles I've written, but a CEO's job primarily is to sell his stock. So you have to put some degree of skepticism into what they say and some analysis, but at the same token, they have an obligation to be truthful. So you can get a lot out of not just what they say, but what they don't say. So today we're going to start with NOV. NOV had a really bad quarter, but I think that their CEO, Clay Williams, really assesses where we're at and where we've been. So let's take a listen, because these calls, by the way, are about an hour to an hour and 5 minutes each, and I'm trying to summarize for you the best points and the best parts. So let's take a listen to how Mr. Williams summarized the state of the current market.
Thank you, Lauren. In the first quarter of 2019, NOV generated $1.94 billion in revenue, a decrease of 19% sequentially, and an increase of 8% year on year. EBITDA was $140 million, down $139 million sequentially, representing 30% decremental leverage as EBITDA fell by half. Late last year, we witnessed one of the sharpest and fastest declines in oil price on record, as WTI fell to $45 per barrel, along with rising demands from investors that oil companies exhibit more capital discipline and austerity. Oil companies responded by signaling their plans to trim CapEx and reduce activity as we enter 2019. NOV's largest customers, the oilfield service companies that execute well construction plans for these oil companies, in trying to divine what the new year would hold, all seem to decide that discretion is the better part of valor, and they threw the brakes on their spending for the tools that they buy from NOV. Oilfield service companies are skilled at slashing spending during market slowdowns, and our phones went quiet in December and January. Our poor first quarter financial results reflect a sharp air pocket that arose from this latest round of capital austerity following that oil price dip. Broadly speaking, the factors that we cited on our last call underpinning our revenue guide down to be in the low teens ended up hitting with more ferocity than we expected, leaving revenues down 19% sequentially instead. While the outlook remains uncertain, WTI rebounding into the $60 range and Brent into the $70 range has helped improve our outlook, particularly in the offshore and international markets.
So obviously Mr. Williams talks about a large drop, and that's a fairly foreseeable drop. The one thing I found particularly interesting about his comments was that he said that most of his orders came in March. So it seems like January and February cooled, which I think is a trend that all of us have observed in our business, but maybe haven't been able to quantify. And now I think Mr. Williams has provided some background, some colors to maybe why we're all seeing that. The next CEO is Mr. Miller from Halliburton. I think you'll find some of his takes on the market fairly interesting, so let's give a listen to what he has to say.
Thank you, Abu, and good morning, everyone. What a difference 90 days make in this market. Commodity prices have rebounded, customer budgets have refreshed, and we're back to work. Our results for the first quarter played out as we expected, and I'm pleased with how our organization executed, both in North America and internationally. From a macro perspective, 2019 is off to a strong start. Commodity prices have been rising since the beginning of the year due to tightening oil supplies and stable demand. OPEC plus production cuts and supply disruptions from Venezuela, Iran, and Libya have supported market rebalancing. Oil demand trends, particularly in China and India, have also been constructive. Overall, the macro environment remains favorable for our industry. Now let's turn to our North America land hydraulic fracturing business. We experienced an increase in stages pumped every month this quarter, with March finishing on a high note. Overall, the first quarter activity level was modestly higher compared to the first quarter of 2018. As expected, we had pricing headwinds throughout the quarter. However, we believe the worst in the pricing deterioration is now behind us. And as we've discussed in the past, the success of our hydraulic fracturing business is not dependent on pricing alone. Given our presence in all basins and exposure to all customer groups, we have the ability to pull other levers, such as utilization, cost savings, and operational efficiency, to drive a better outcome for our business. Let me describe what I believe will happen with hydraulic fracturing supply and demand throughout 2019. On the demand side, it's evolving as we had anticipated. Our customers have announced their 2019 budgets, and we expect that overall spend will be down 6 to 10% in North America. Here's how I see the impact of our customers' 2019 budgets on the North America land stimulation services business. I expect that customers will operate within their budgets largely by achieving savings through sand cost deflation and by reducing drilling activity. On the other hand, I believe that net completions activity will remain essentially flat year on year as our customers seek to achieve their publicized production targets. In the near term, our view on North American customer activity heading into the second quarter is shaped by the momentum that we saw building at the end of March. As for the next couple of quarters, I see demand for our services progressing modestly. The cadence of spend across basins for various companies will look different throughout the year, but Halliburton has the scale, range of services, and customer relationships to capture more than anyone else out of every dollar spent in North America land this year. Turning to international markets, I'm excited by what I see. The international recovery continues to build momentum. Halliburton has gained share in key international markets over the last several years. This gives us a strong base to capitalize on the recovery, and we expect high single-digit international revenue growth this year. The international recovery was initially led by the national oil companies and focused on mature fields. Now, the offshore markets are also entering recovery mode as project economics become more attractive. International offshore spending is projected to be up 14% in 2019, and the average offshore international rig count increased 29% year on year in the first quarter. A great example of an emerging offshore rebound is our recent win with Shell in Brazil. Finally, the third focus area for this year, we will continue to differentiate in a very important but highly competitive space in hydraulic fracturing. The intense exploration of top-tier acreage fueled by rapid trial and error technology cycles led to the explosive increase in production from U.S. unconventionals that we have seen in the past decade. As shale matures and operators have to step out to second-tier acreage, it will become increasingly hard to add enough production capacity to replace the significant legacy decline volumes, as well as drive new production higher. Going forward, higher activity and more advanced technology will be needed to maintain flat production levels in unconventionals.
So one of the greatest points I took from Mr. Miller's summary is that offshore is coming back, and that seems to be a trend this earnings season, as a lot of the CEOs have focused on offshore and particularly shallow water offshore sort of having a renewed vigor. And that's important. I think that a lot of us have been questioning where or when offshore is coming back, and this provides us some color. Now, next we'll move on to Schlumberger. As a lot of you know, I have an absolute fascination with the CEO of Schlumberger. I think he's a brilliant man, and I tend to hang on to most of what he has to say because I think he has some of the most artful and articulate and best reasoned analysis of all the CEOs, which may be why he's the CEO of one of the world's largest companies. So I wanted to break his down into a couple of points. And the first is I'd like you to listen to what Mr. Kilsgrad had to say regarding the state of the market as it exists.
Turning lastly to the industry macro, where we continue to expect oil market sentiments to steadily improve over the course of 2019. Our view is backed by a solid demand outlook, the full effects of the OPEC and Russia production cuts, the slowing shale oil production growth in North America, and the further weakening of the international production base as the impact of 4 years of underinvestment becomes increasingly evident. The recent strength in the price of crude oil, with Brent again breaking through the $70 per barrel level, is supporting this outlook. We also see clear signs that E&P investment sentiments are starting to normalize as the industry heads towards a more sustainable financial stewardship of the global resource base. Directionally, this means higher investments in the international markets simply to keep production flat, while North America land activity is set for lower investments with a likely downward adjustment to the current production growth outlook. In the international markets outside the Middle East and Russia, the inevitable production decline resulting from the record low investment levels seen in the past 4 years is now becoming increasingly visible. First quarter oil production in the international markets outside OPEC was down 400,000 barrels a day versus Q1 of 2018 and 900,000 barrels a day versus Q1 of 2017. While the underlying decline in the aging production base in key oil-producing countries such as Norway, UK, Brazil and Nigeria has so far been offset by new project startups, the need for a stronger supply-side response is becoming increasingly evident. Strong new investments are also needed in countries like Mexico, Angola, Indonesia and China, where total production has been in noticeable decline for several years. With this industry backdrop, we continue to execute our plan for 2019, targeting high single-digit international revenue growth with a business focus and capital deployment strategy as I have already outlined. Looking at the first quarter, the growth in the international rig count, both on land and in particular offshore, the rise in the number of new project FIDs and subsea tree awards, and a renewed interest in exploration is all supporting our outlook. Conversely, in North America land, the higher cost of capital, lower borrowing capacity, and investors looking for increased returns suggest that future E&P investments will likely be at levels dictated by free cash flow. We therefore see land E&P investment in North America down 10% in 2019. In addition to the lower investments, increasing technical challenges from well interference, step out from core acreage, and limited further growth in lateral length and proppant per stage points to a more moderate growth rate in U.S. shale oil production in the coming years. The normalization of global E&P spending with increased international market investments and a reduction in North America land capex represents a positive market shift for Schlumberger, and we welcome the return of a very familiar opportunity set given our unmatched global strength.
All right, so a few interesting points there, particularly his focus on a higher growth internationally and a lower growth in the North American market. I think we're seeing the signs of that, right, with decreased rig counts and some cooling of the activity in the Permian. The next clip I want to play for you has to do with where he sees growth. He was questioned by one of the analysts about his growth anticipation, or his anticipation for growth. And I want you to listen really directly to what he has to say. So let's take a listen.
On to a question for line of Scott Gruber with Citigroup. Please go ahead.
Yes, good morning.
Good morning.
I want to follow on Angie's question and stay on the international side and looking at the growth potential. I'm really curious about how you see long-term growth shaping up. So if we paint a scenario and, take a look at the forward curve and say crude stays, around the $65 to $70 level on Brent, how many years of reasonable growth, call it mid-single digit, can be reasonably expected as reinvestment rates normalize and assuming no major change in crude?
Well, I think if you look at where investment levels were back in the period 2010 to 2014, obviously internationally now we are still almost around half of those investment levels. And if you were to say that the new normal is somewhere in between where we are and where we used to be, you still need multiple years of not even single digit but probably double digit growth in order to get back to even the halfway point between investment levels in 2014 and investment levels as of today. So we still see a fairly decent runway for increased international investments, and you also see that the need for this in the production declines that we are now seeing in the mature production base internationally.
The reason I find this clip so important is that a lot of times at 5-Star, we've had a lot of debates. We've talked to a lot of our customers. We've talked to a lot of our supply chain about what is the new normal. All of us saw, fairly good numbers going into the downturn before 2015. Started seeing some slacking in 2015. Then 2016 was obviously really a bad year, with 2017 picking up a little bit. But one of the questions we keep asking ourselves is this past year, was 2018 a good year, a medium year? What was 2018? And how do we plan our business around that? So I think that his analysis is about where we have come up with, which is we're certainly not at the lowest point. We're not at the highest point. If you take what was and kind of average that out to where we got to. Somewhere in the middle is the new normal. Now, whether that's truly in the middle, I don't know. I don't think he knows. But what we all seem to acknowledge is that what existed before the downturn probably is not going to exist again. And we can all, as long as we all have some understanding of that, I think we can all plan our business around it. The final point he makes is where he sort of sees the market for 2019. I want to conclude the earnings calls with that. So let's take a listen.
Good morning, everyone.
Good morning.
Good morning.
So Paul, a lot of emphasis, rightly so, on the international market. So I might want to maybe shift the Q&A, and you mentioned what's going on in North America and activity level being down 10%. Sounds like that's maybe at the lower end of what you had previously discussed. So I was wondering if you just give us some insights. Are you getting any better visibility now that oil prices have been higher than what these E&P companies have been budgeting for? And could you give us an update? I think you idled a couple of frac crews during the course of the fourth quarter, and whether or not there's been sufficient enough activity now to kind of bring those crews back in. And generally, maybe just you talk about potential for pricing improvement internationally. So, maybe give us some similar kind of context around pricing dynamics, in the North American market.
Yeah, okay. So I would say, first of all, we see a fairly consistent discipline from the customer base at this stage around living within, or at least much closer to their free cash flow. This I think is partly driven by the management teams as well as from the investor side. So with that's really what's driving our prediction of about 10% down in E&P investments in North America land. As we go forward into the full year, visibility for the second half of the year is still fairly limited. For Q2, we are expecting the number of frac stages to go up, but a fair bit of that activity increase is going to be offset by the full impact of the pricing concessions that we gave in the fourth quarter and the first quarter. We do expect hydraulic fracturing pricing to stabilize in terms of bid pricing in the second quarter. Now, how this is going to evolve for the second half of the year, lack of visibility, I think, is still the case. I don't think, though, at this stage that if we have a further run-up of the oil price, we're going to see the same rapid increase in spending as we've seen in previous years. There might be some increase, but probably not as much as we saw, for instance, in 2018. So I think that calls for another challenging year on hydraulic fracturing. Our focus here is just to continue to drive the efficiency of our operations, and then focus on the commercial terms we have with our customers. And the focus here is not necessarily top line or market share. It's about margins, earnings contribution, and cash. We have no capex planned to be deployed this year for fracking. We reactivated all the warm stacked crews that we set aside in Q4. They are now back up and running, and we still have another 8 fleets that we can deploy without any capex requirements. So that's on the frac side. On the drilling side, we saw the rig count come down a bit in Q1 as expected. It might slide a little bit further in Q2 as well, and for sure we don't expect any major rebound in rig activity over the course of this year. So that will have some impact on our drilling business, and mainly on the basic technologies. And we still see strong uptake on rotary steerable and still solid pricing and profitability on that. So it's a bit of a mixed outlook for U.S. land. I think it's going to be a challenging year.
So again, I'm giving you sort of a representative sample of the points I think are most important. All of these transcripts are available to read in full, as are all the audio clips are available online. You can readily find them. I just wanted to save you the 3 hours and 45 minutes or so of having to listen to them or read through them. I hope that you found these clips helpful. If you like this video, please subscribe to our YouTube channel, smash that like button, and as always, from all of us at 5-Star Metals, thank you for your friendship, thank you for your support, and thank you for your business. Let us know if there's anything we can do for you. Take care.